Today I will continue talking about the expenditure cycle. I will start first with a revision for the previous part, then I will move to the new part for today's lecture. What is the meaning of the expenditure cycle? The expenditure cycle is a set of business activities and related information processing operations associated with the purchase of and payment for goods and services. In the expenditure cycle, the primary external exchange of information is with suppliers. Within the organization, information about the need to purchase goods and materials flow to the expenditure cycle from the revenue and production cycles, inventory control, and department. Once the goods and materials arrive, notification of their receipt flows back to those sources from the expenditure cycle. Expenses data also flow from the expenditure cycle to the general ledger and reporting function for inclusion in the financial statements and various management reports. The primary objective of the expenditure cycle is to minimize the total cost of acquiring and maintaining inventory, supplies, and services. In order to be able to achieve the primary objective of the expenditure cycle, there are some decisions need to be made, such as what is the optimal level of inventory and supplies to carry? Which suppliers provide the best quality and service at the best prices? How can the organization consolidate purchases across units to obtain optimal prices? How can information technology be used to improve both the efficiency and the accuracy of the inbound logistic functions? How can the organization maintain sufficient cash to take the advantage of any discount suppliers offer? How can payment to vendors be managed to maximize cash flow? There are four basic activities performed in the expenditure cycle, which are ordering material supplies and service, receiving the material supplies and service, approving supplier invoices, and finally cash disbursements. Today we will talk about ordering material supplies and service. The first major business activity in the expenditure cycle is ordering inventory, supplies, or service, which involve two main steps. The first step is to identify what, when, and how much to purchase, and second step, choosing which supplier to purchase from. Inaccurate inventory records can create significant problems for organizations. Therefore, accountants and systems professionals need to understand best practice for managing inventory. We have three main approaches in order to control the inventory. The first one is economic order quantity. The second one is materials requirement planning, and finally just-in-time inventory. The traditional approach to managing inventory is to maintain sufficient stock so that production can continue without interruption, even if inventory use is greater than expected or if suppliers are late in making deliveries. This traditional approach is often called the economic order quantity approach because it's based on calculating an optimal order size to minimize the sum of ordering, carrying, and stock out cost. Ordering costs include all expenses associated with processing purchases transactions. Carrying costs are those associated with holding inventory. Stock out costs are those that result from inventory shortage, such as lost sales or production delay. The reorder point specifies when to order. Company typically sets the related point based on delivery time and desired level of safety stock to handle unexpected fluctuations on demand. The second approach is the material requirement planning, which seeks to reduce required inventory levels by improving the accuracy of forecasting techniques to better planning purchases to satisfy production needs. For example, the production planning department of a company using material requirement planning would use sales forecasts to prepare a detailed schedule specifying the quantities of each finished product to manufacture in a specified time period. such as the next 3 months. This schedule and the engineering specification for each product identify the quantities of raw materials, parts, and supplies needed in production and the point in time when they will need it. So, the material requirement planning system reduces uncertainty about when raw materials are needed and therefore enable companies to carry less inventory. The third approach in controlling the inventory is a just-in-time inventory system, which attempts to minimize, if not totally eliminate, finished goods inventory by purchasing and producing goods only in response to actual, rather than forecasted sales. Consequently, just-in-time systems are characterized by frequent delivery of small amounts of materials, parts, and supplies directly to the specific locations that require them when they are needed, rather than by infrequent bulk deliveries to a central receiving and storage facility. Therefore, a factory using just-in-time system will have a multiple receiving docks, each assigned to accept delivery of items needed to nearby work centers. Regardless of its sources, the need to purchase goods or supplies often results in the certain of a purchase requisition that identifies the requisitioner, specifies the delivery location and date needed, identifies the item number, description, quantity, and the price of each item requested, and makes a guess as supplier. The person approving the purchase requisition indicates the department number and the account number to which the purchase should be charged. What are the potential problems or threats that can face ordering goods? Inaccurate inventory records can result in stock out that lead to lost sales or to carrying excess inventory that increase costs. To reduce the risk of these problems, a perpetual inventory method should be used to ensure that information about inventory stocks is always current. However, data entry errors can result in accurate perpetual inventory records because even expert typists do make mistakes. Therefore, using information technology to eliminate the need for manual data entry can improve the accuracy of perpetual inventory records. The second threat is ordering unnecessary items. Another threat is purchasing items that are not currently needed. Accurate perpetual inventory records ensure that the validity of purchase requisitions that the inventory control system automatically generates. Supervisors need to review and approve purchase requisitions that individual employee initiates. A related problem is multiple purchases of the same item by different subunits of the same organization. As a result, the organization may be carrying a larger inventory than desired and may fail to take advantage of volume discounts that might be available. The solution of this problem is a centralized purchasing function, which can mitigate this threat. Once the need to purchase has been identified, the next step is to select a supplier. The buyer usually performs this task. In manufacturing companies, the purchasing function is closely related to the production cycle. Several factors should be considered when selecting suppliers. What are these factors? Are price, quality of the materials, dependability in making deliveries. It's also important to track and carefully evaluate supplier performance, including data on purchase prices, rework and scrap costs, supplier delivery performance. The purchasing function should be evaluated and reworded based on how well it minimizes total cost, not just the cost of purchasing the goods. Once a supplier has been selected for a product, their identity should become a part of the product inventory master file, so that the selection process doesn't have to be carried out for every purchase. A list of potential alternatives should be maintained for products that are seldom ordered. The selection process may be repeated every time. A purchase order is an electronic form that formally requests a supplier to sell and deliver specified products at a specific prices. It's also a promise to pay and become a contract once the supplier accepts it. The purchase order includes the name of the supplier and the purchasing agents, the order and requested delivery dates, the delivery location and shipping method, and the information about items ordered. Frequently, several purchase orders are generated to fill one purchase requisition, because different agents may be the preferred supplier for the various items requested. The quantity ordered may also differ from that requested to allow the purchaser to take advantage of quantity discounts. Many companies maintain special purchasing arrangements with important suppliers. A blanket purchase order or blanket order is a commitment to purchase specified items and design at specific prices from a particular supplier for a set time period. Most of them they are 1 year. Blanket purchase orders reduce suppliers' uncertainty about reliable sources of raw materials and help the supplier plan its capacity and operations more effectively. Vendor-managed inventory programs provide another means of reducing purchase and inventory costs. A vendor-managed inventory program essentially outsources much of inventory control and purchasing function. Suppliers are given access to sales and inventory data and are authorized to automatically replenish inventory when stocks fail to redundant reorder points. This arrangement cuts carrying costs by reducing the amount of the inventory on hand and lower processing costs by eliminating the need to generate and exchange formal purchase orders. What are the problems and threats that can face choosing a supplier? 5 threats to place orders with suppliers. The first one is to purchase items at inflated prices. The cost of purchasing a component represents a substantial portion of the total cost of manufactured products. Therefore, companies strive to secure the best price for the items they purchase. Several procedures can help ensure the companies don't pay too much for specific products. Price lists for frequently purchased items should be stored in the computer and consulted with whether orders are made. The prices of many low-cost items can be easily determined from catalogs. Competitive written bids should be provided for high-cost and specialized products. Purchase orders should be reviewed to ensure that these processes have been followed. Budgets are also helpful in controlling purchasing expenses. In attempting to obtain the lowest possible prices, another threat is purchasing inferior quality products. So the second threat is purchasing goods of inferior quality. Substandard products can result in costly production delays. Moreover, the cost of scrap and rework often results in higher total production costs than if higher quality, more expensive materials had been initially purchased. One best practice is to establish a list of approved suppliers known to provide goods of acceptable quality. The third threat is unreliable performance by suppliers. One way to reduce the risk of problems within supplier dependability is to require suppliers to be certified as meeting international quality standards. The fourth threat is to purchase from unauthorized suppliers. Purchasing from unauthorized suppliers can result in numerous problems. Items may be of inferior quality or overpriced. The purchase may even cause legal problems. Different government agencies maintain lists of individuals and companies with whom it's illegal to transact business with. Payment to entities on such lists can result in substantial fines and sometimes deleted from the government. Consequently, all purchase orders should be reviewed to ensure that only approved suppliers are used. It is especially important to restrict access to the approved supplier list and to periodically review this list for any unauthorized changes. The last threat is kickbacks. Kickbacks are gifts from suppliers to purchasing agents for the purpose of influencing their choice of suppliers, which is the last threat. For the kickback to make economic sense, the supplier must find some way to recover the money spent on the prep. This usually is accomplished by inflating the price of subsequent purchases or by substituting goods or inferior quantity. Even if neither of these problems happen, kickback impairs the buyer objectivity. To prevent kickbacks, companies should prohibit purchasing agents from accepting any gifts from potential or existing suppliers. Kickbacks are difficult to prevent, so detective controls are also necessary. The second major business activity in the expenditure cycle is the receipt and storage of ordered items. These two steps are different processes because each is performed by a different organizational function. The receiving department is responsible for accepting deliveries from suppliers. It's usually reported to the warehouse manager, who in turn reports to the vice president of manufacturing. The inventory storage department, which also reports to the warehouse manager, is responsible for the storage of the goods. Information about the receipt of ordered merchandise must be communicated to the inventory control function in order to update the inventory records. When a delivery arrives, a receiving clerk compares the purchase order number referenced on the supplier packing slip with the open purchase order file to verify that the goods were ordered. The receiving employee then counts the quantity of goods delivered before routing the inventory to the warehouse or factory. The receiving employee also should examine each delivery for sign of obvious damage. The receiving report document provides details about each delivery, including the data received, the date received, shipper, supplier, and purchase order number for each item received. It shows the item number, description, unit of measures, and quantity. The receiving report also contains space to identify the persons who received and inspected the goods, as well as for remark concerning the quality of the items received. The three possible exceptions to this process are receiving a quantity of goods different from the amount ordered, receiving damaged goods, or receiving goods of inferior quality that fail in the inspection. In all three cases, the purchasing department must resolve the situation with the supplier. Usually, the supplier will give the buyer permission to correct the invoice for any difference in quantity. In the case of damaged or poor quality goods, a document called a debit memo is prepared after the supplier agrees to take back the goods or grant a price reduction. The debit memo records the adjustment being requested. One copy of the debit memo is sent to the supplier, who subsequently creates and returns a credit memo in acknowledgement. The accounts payable department is notified and adjusts the accounts balance owed to the supplier. A copy of the debit memo accompanies the goods to shipping department to authorize their return to the supplier. So, what is the threat or the potential problem that is related to the receiving and storing goods? The first threat is accepting delivery of unordered goods results in costs associated with unloading, storing, and later returning those items. The best control procedure to mitigate this threat is to instruct the receiving department to accept only deliveries for which there is approved purchase order. Another threat is making mistakes in counting items received. Correctly accounting the quantity received is important for maintaining accurate perpetual inventory records. It also ensures that the company pays only for goods actually received. To encourage the receiving employee to accurately count what was delivered, many companies design the inquiry processing system so that when reviewing open purchase orders, receiving dock workers don't see the quantity ordered. The third threat is theft of inventory. Several control procedures can be used to safeguard inventory against loss. First, inventory should be stored in secure locations with restricted access. Second, all transfers of inventory within the company should be documented. Third, it's important to periodically count the inventory on hand and reconcile those accounts with the inventory. Finally, proper safeguard segregation of duties. The third main activity in the expenditure cycle is approving supplier invoices for payment. The accounts payable department approves supplier invoice for payment. A legal obligation to pay supplier arises at the time goods are received. For practical reasons, however, most companies record the account payable only after receipt and approval of supplier's invoice. This timing difference is usually not important for daily decision making, but it does require making appropriate adjusting entries to prepare accurate financial statement at the end of each financial year. When a supplier invoice is received, the accounts payable department is responsible for matching it with a corresponding purchase order and receiving report. This combination of supplier invoice and associated supporting documentation creates what is called voucher package. Once the approver has verified that company received what it has been ordered, the invoice is approved for payment. There are two ways to process supplier invoices, referred to as non-voucher or voucher system. In a non-voucher system, each approved invoice is posted to individual supplier record in the accounts payable file and then stored in an open invoice file. When a check is written to pay for the invoice, the voucher package is removed from the open invoice file. The invoice is marked paid, and then the voucher package is stored in the paid invoice file. In a voucher system, an additional document called a disbursement voucher is also created when a supplier invoice is approved for payment. The disbursement voucher identifies the supplier, lists the outstanding invoice, and indicates the net amount to be paid after deducting any applicable discounts and allowance. Voucher system offers three advantages over the non-voucher system. First, they reduce the number of checks that need to be written because several invoices may be included on one disbursement voucher. Second, because the disbursement voucher is an internally generated document, it can be meant to simplify tracking all payables. Third, because the voucher provides an explicit record that a supplier invoice has been approved for payment, it facilitates separating the time of invoice approval from the time of invoice payment. This makes it easier to schedule both activities to maximize efficiency. To eliminate supplier invoices, after all, for most recurring purchases, companies know the prices of goods and services at the time they are ordered. So, as soon as receipt of goods and services is verified, all the information required to pay the supplier is already known. This invoiceless approach is called evaluated receipt settlements. ERS replaced the traditional three-way matching process, which are supplier invoice, receiving report, and purchase order, with a two-way match of the purchase order and receiving report. ERS saves the time and money by reducing the number of documents that need to be matched and then the number of potential mistakes or mismatches. So what is the threats or the potential problems related to approving supplier invoice? The first one threat is error on supplier invoice, such as difference between quoted and actual price charged or miscalculation of the total amount due. Consequently, the mathematical accuracy of supplier invoice must have been verified, and the prices and quantities listed there in compared with those indicated on the purchase order and receiving reports. The second threat is mistakes in recording and posting payment to suppliers result in additional errors in financial and performance reports that in turn can contribute to poor decision making. The data entry and processing controls to ensure processing integrity are necessary to prevent these types of problems, such a control is to compare the difference in supplier account balance with the total amount of invoice processed before and after processing checks. The total of all suppliers' accounts balance also should be reconciled periodically with the amount of accounts payable control account in the general ledger. That's all for today. Thank you for listening.